savings as a percentage of GDP are estimated to be below 30% for FY13. Investors are wary, worried, or simply watching. What will it take to change the mood? While the US and Europe are signaling strength, India is headed towards lower growth and general elections. Joining me today on Market Guide is MD and CEO of the BSE, Mr. Ashishkumar Chauhan, with his reading of investors as well as investment opportunities. Mr. Chauhan, thanks so much for being with us on the show today. We're trying to gauge the mood sort of picked up in the first week of September. We had some IIP numbers to bolster that sentiment. Would you say that this is indicative of a change in the tide, or should we still wait to find out some more?
I think it's early days, but the signals are good. Of course, the new governor in RBI also has sort of set up in motion various processes. And I'm sure everyone is aware of the issues. Everyone is also aware of the strength that is being seen in Japan, in even China. I've been told recently there has been a lot of strength in the sort of manufacturing numbers in Europe and in US. So effectively, if the world does well, India would certainly do well. And second thing is, if you remember or if you recall 1991, the first, I think the most important rather, first and the most important activity that was done was devaluation. It ended up kicking off a liberalization framework, but for me, by having a devaluation of such a large magnitude, what has happened is that suddenly India has become very competitive. We were losing the business of services, of manufacturing to various other countries like Philippines. I read yesterday that now Philippines has become less competitive on cost vis-a-vis India. And so for me, it's a very interesting conundrum that by having this kind of devaluation, if you become competitive and it allows you to kick off or kick start the economy, basically you are on the right track. And so many actions which are being taken for businesses, for the population in general, the subsidies and controlling of them, giving commitments on current account deficits and all. For me, we are on a very sort of strong wicket. We are on right track. And 91, mind you, was a very bad time. So we didn't have even 15 days of money to import.
Reserves, yes.
Right. And so today we are in a significantly strong position. Of course, the way I look at it is without crisis, democracies don't take tough decisions. And in some sense, this was probably an artificially manufactured crisis of sorts. You know, we were expecting a crisis and we ended up creating a self-fulfilling prophecy, and that has allowed the policymakers a room to take tough decisions, which they have taken now, and they'll continue to take, I'm sure. So effectively, going forward, I see a very positive move in terms of industrial activities, exports, and so on and so forth.
You mentioned, you know, of course, the announcement of the new governor of the RBI gave a lot of joy to the markets overall and a lot of confidence as well. What are the measures that you think, he has at his disposal, and the steps that one needs to take to continue or give a little more impetus to the wheels? The
way I look at it is the devil is in detail. So if the policies which need to be implemented, if they are thought through very much in terms of implementation, less harassment, ease of execution, and so on and so forth, which is what is actually the last few announcements were about, streamlining the activities and so on and so forth, and they have been taken really well by everyone. So for me, that concept of getting into the details, asking the marketplace, also asking the people who actually operate on such policies about how to make them sort of easy to use, less and hassle-free basically, and that is one large piece. Second large piece is about taking what I call strategic decisions. Somewhere on the line, that large strategic decisions, see, there are what I call strategic decisions, there are tactical situations, and there are operational issues. So you need to ease the operational part of it. Even your new policies have to be easy to operate and monitor and sort of comply with, because compliance is a very large portion of today a businessman's job and a large business job. But the strategic, what I call large issues, which now are being taken up and implemented with ease, for me that gives a lot of sort of confidence. But at the same time, the world is going to go through a reasonable amount of volatility.
Exactly, that was what I was wondering, because when we're talking of India, especially over the last since about 2008 especially, when the Indian investor has really backtracked, whatever be his pocket size. Corporate India has been so wary till recently of sort of investing or infusing fresh capital into projects. How much volatility are we going to see? The Fed Reserve is going to test waters with easing up of Q3. We are seeing some signals of strength from Europe, Japan, etc. And our equity markets are owned primarily by foreign institutional investors. Domestic participation has been a small share of it.
See, the way I look at it is the volatility internationally will be slightly higher than what it was in last, say, 3-4 years because of the QE part of it, and also each country trying to readjust its own estimations, its own aspirations with the newer realities that are emerging. And even US will also be fine-tuning the QE as it goes because of the repercussions it may have on its own economy. And so the effect and counter effect would continue, and the skill, in my opinion, of the policymakers, especially in India and even say Brazil or Turkey or Indonesia or China or Russia, would be that if the worldwide, if there is a storm, a small storm or a large storm, if it brews up, how do you maneuver your boat into the safer zones, right? And either by planning or by tactics. And so for me, one is strategic part, which is long term. How do we take our boat, our economy into a safer zone with higher sort of foreign exchange reserves, lower current account deficit, getting more, because we have basically two issues which affect largely our current account deficit, and that sort of affects our everything else, is basically oil imports and gold. And if we are able to create incentives for people to sort of produce more oil locally, then that's it cannot happen overnight. It will take 3, 5, 10 years of sort of working hard to get it done, or alternative energy or other energy sources like hydel or nuclear and so on and so forth. So that is one large piece we need to resolve as a society over next 5, 10 years. The second thing is, and gold, the government has started taking strategic decision on restricting the gold imports and creating frameworks for using the current gold available in India for day-to-day use and so on and so forth. So for me, if we can resolve these two parts on a strategic basis in immediate or long term, that's going to ease up a lot of sort of bottlenecks. Second thing is still what we sell to the rest of the world is basically labor. We have skilled labor, we have unskilled labor, we have several types of sort of skills available in India, and for that, if we have to become attractive for the world to make us the manufacturing hub or a services hub or otherwise, we need to have policies to attract them. But more importantly, our labor has to be cheap and more efficient and more effective,
yes.
Right, and more committed to do a job which their counterparts in other countries might not be able to do, or may be able to do at much higher cost or lower quality. And that's where we need to do skill development, skill enhancement.
We're going to take a break here, sir. Stay with us on Market Guide on the other side. BSE itself is the oldest exchange in Asia. What is your vision for the retail investors? Welcome back. You're with Market Guide with MD and CEO of the BSE, Mr. Ashish Chauhan. Mr. Chauhan, you were talking about how we need to create long-term plans, strategies, so as to avoid any kind of economic fluctuations like we witnessed over the last some time. Now, one result of that economic fluctuation has been the performance of corporate India and the battering that the confidence of the retail investor has seen. What would your advice be to any investor watching this program?
The investor, first and foremost, needs to learn which are the choices they have available. Then they need to also figure out what are their needs going to be as far as they can see. If they are young, they would want to behave differently vis-a-vis people who are sort of in retirement. And so they need to figure out what they want to sort of invest for, what are the choices they have available. And then they need to take a call, is that what has happened to that asset class? Because many times, although we are taught in economics that when the price of an asset goes up, the demand goes down, but that is true for consumption items like potatoes and so on and so forth. But for investment items, actually people invest more if the prices go up more. So we tend to believe that the past behavior of an asset class will continue to be the same in future. So for me, the real estate has given huge returns over last 10 years in India. Gold has given pretty large returns, partly due to the gold prices going up internationally, but partly due to rupees depreciation also. So effectively, India's money which is going into non-financial instruments over last 10 years, actually they have gone from say gold to real estate in a large way. So if India basically invests now less than 8% of its savings into financial instruments. But if you invest now in financial instruments, whether by way of fixed deposits or insurance or mutual funds or directly investing in stocks or ETFs and so on and so forth, you would be basically investing in India's growth, because what you invest in goes to the companies for setting up manufacturing plants or setting up services activities or hotels or defense and so on and so forth, and those guys create jobs. Today on stock markets, you can invest in equities, equity derivatives, debentures, corporate debt as we call it, mutual fund distribution, and many instruments including currencies. And so how do you sort of estimate your requirements, your horizon in terms of the time frame,
and divide your portfolio among these various instruments available?
And by looking at the past, saying if this asset has given so much returns in the past, will it give similar returns in the future, or something else needs to be sort of gone into, is what is the trick you need to employ. And I think nobody is better than the investor himself
to gauge that. BSE itself is the oldest exchange in Asia. What is your vision for this, for the retail investors? How do you see it being able to embrace all these new technologies, these new requirements, and service its clients?
People trust market more today than they trust other asset classes in the same sort of financial instruments class. Having said that, we have not been able to reach more than 2% of Indian population, and so 98% of the population is still untouched in terms of investing in a stock market kind of a framework. For me, technology is only a tool. The best thing that is happening using technology is that earlier why we couldn't reach the towns, small towns and villages and so on and so forth, basically it was because of the costs. You had to set up branch networks, the brokers had to actually spend a lot of money, and there were no coordination points that were available. Now the newer technology allows people to trade through internet, through mobile, gives them information on real time, and even through television like yours. And so effectively the cost of servicing a customer or an investor has come down drastically. And the second part of the sort of puzzle is about financial literacy. How do we reach out to people, make them aware that these are the various choices you have available in formal financial markets? The technology is allowing the financial market intermediaries, which are regulated well, to now go out into official towns, villages, and actually service these areas. So now, how do we make them aware of the choices, various choices, not only stock markets, but various choices that are available to them, how they can sort of participate in these markets in a safe, easy and hassle-free way. And once they participate, normally this also flows by example. So some people are able to invest well, and other people actually look at them, and that's how sort of the investment cycle starts. And that I have seen from FERA company days in 70s to later on in late 80s, and then even in sort of .com time. A lot of people come in because they send their they see their friends, relatives actually investing well, earning great sort of good returns, and that's how they participate in those activities, whether that is insurance or and what will happen is, because we have not yet reached the formal finance, which is highly regulated, has not reached the local towns, I mean small towns and villages, we have kept space for unscrupulous people like so-called cheat funds and all to move into that, take people's money and then not return. So basically there are two sort of good things about two pronged strategies for us to, one is use technology to reach out, and that will also help people to understand that there is a formal mechanism of finance or financial markets which are available, and that is much more protected, much more oversight from the government agencies, and that ensures that their money is safe. And once they see that by experience, of their friends, their own, and so on and so forth, they would want to invest more in the formal financial markets rather than informal markets, where they end up actually being taken for a ride.
Right. So better investor education to improve financial inclusion of the 98% that you say still needs to be introduced to investments, wealth creation, and to the equity markets. We're going to continue in conversation with Mr. Ashish Chauhan. Stay with us on Market Guide. We're talking about a possibility of a small and medium enterprises exchange. We have the same 5,000 to 6,000 companies listed as of now on the equity bourses. How is the life of an investor going to change? Welcome back. You're with Market Guide in conversation with the MD and CEO of the BSE, Mr. Ashish Chauhan. Mr. Chauhan, we were talking about the BSE and its goals, and you were talking about how technology has been a tool which is allowing platforms like the BSE to service clients for lesser investment. Now we're talking about another exchange with the MCX. We're talking about a possibility of a small and medium enterprises exchange. We have the same 5,000 to 6,000 companies listed as of now on the equity bourses. How is the life of an investor going to change?
The way I look at it is more choices is always better because then you can pick and choose what sort of matches your expectations, your aspirations, and so on and so forth. So effectively the brokers who are also users of the exchange platforms, the investors who are also users of the exchange platforms for transaction processing, and then there are clearing corporations which provide the settlement guarantees, and then depositories which keep the shares for the investors on their names. So this is the financial infrastructure, the modern sort of technical financial infrastructure that has been created over the last 20 years, has kind of created a framework for taking many more investors. Earlier, if I recall, in say before markets had become automated, the floor used to be significantly smaller compared to what was the need in those days. After that, many more companies have got listed, and you don't see the capacity constraints. At the same time, the information that is available to the investor is of far superior quality, much better sort of information dissemination. The speed is also increased. In sense, we have today Indian markets, especially Indian securities markets, are considered amongst the best users of technology in the world, and in some sense that has also given us confidence that we can reach out to the masses at very, very low cost. And somewhere on the line, how do we now use more and more the exchanges for capital formation? If we don't sort of use the capital for capital formation, but sort of fritter it away in gold, silver, or real estate investments, we are actually not doing service to our own need for getting returns, because many of these asset classes may not give you appropriate returns in the future.
True.
But we are also doing a disservice to the nation, because the nation currently needs to invest into job creation. And so effectively more and more companies need to come and list. For that, as you rightly mentioned, the SME platform is a very interesting platform that small and medium sized companies which were not actually listing on Indian exchanges over last almost 15-16 years are now being allowed to come raise funds for their growth and also for wealth creation. The other part is that somewhere on the line over last 10-15 years, because of the various sort of changes we have undertaken in our stock markets, the pricing of IPOs is pretty much on a fair value basis. That is, the upside post listing is hardly there. Whereas in SME, because the promoters are also not very confident of their skills and their ability to sort of command those prices, they end up giving much more sort of discount vis-a-vis the fair value, and so there is a huge upside that is available post listing into SME. So that is one instrument which people should carefully kind of consider asset class or a sort of a sub asset class which people should carefully consider. Similarly, there are other instruments which are basically coming up, as you said, on inflation index bonds.
In fact, that was my question to you. How many takers will there be for it? Because the worry is that inflation indexed bonds, will they be linked to, you know, the WPI? The structure of the WPI and the CPI itself has been from time to time, you know, been criticized for what all is included, how is it measured. Also with the situation that we've had with the current account deficit, etc. How many takers will they be for it? How do you view this particular offering?
The first principle is it a good instrument in principle? I think it's a fabulous instrument for savers, because over last almost since independence, there have been very few rare time frames or rare periods in which the interest rate has been, real interest rate has been positive. Almost the entire period, barring few occasions where we had negative real rate of interest. So having inflation index bonds which gives you positive real interest is a what I call a breath of fresh air, right? And that will bring in hordes of people wanting to invest in what I call risk-free framework. Second thing is the structure of the instrument, that whether it is linked to a particular type of index, whether the index characteristics correct or not. So that is more of a structuring part of it. So principle is very good. Now how do we sort of execute it? And then if we by chance we fail somewhere, how do we reiterate, continue to come back till the time we succeed? So that requires what I call courage, conviction and humility, saying that I have failed, so let me change and ask people what failed, and then make it actually useful for people, so that it's a win-win for both. It helps us sort of raise funds either for the government or for the private sector even, and the other side, it meets genuine need of the savers in all these areas. But overall, I think it's a very, very impressive thought, and the execution, even if you fail once, especially, I mean, I have seen it in derivatives, internationally almost 95 out of 100 products fail. But that doesn't mean you stop trying, right? So idea is India is now sophisticated enough. People have sort of needs which are varying. People are now becoming financially much more literate. The processing part of it, which used to be the largest problem of getting bad deliveries, not having correct prices, and so on and so forth. No transparency, all of that is gone. So now for me is the right time to introduce newer mass market products, because you can get carried away, create very complex, very niche sort of leveraged products, and you can create some more issues later on.
Right.
But if you are able to create mass market investment products, I think we would be doing a great job going forward.
Thank you, sir, for that. That was Market Guide in conversation with the MD and CEO of the BSE, Mr. Ashish Chauhan, who said that we need more mass market funds for wealth creation among Indian investors, and inflation index bonds are a step in that direction. Thanks very much for being with us on the show today.